Joe, welcome to Searching for Mana.
Thanks, Lloyd. Lovely to be here.
Pleasure to have you on the show. To fill the audience in, Joe Parkin is head of UK banks and digital channels with BlackRock, has been working with them for several years and worked for 5 or 6 before that at Goldman Sachs. I want to just start the show giving some type of context around BlackRock. So BlackRock is an American global investment management corporation, global 70 odd offices around the world. Initially as a risk management and fixed income institutional asset manager, BlackRock is now the world's largest asset manager with 7.4 trillion in assets under management. So congratulations, Joe. Good work. It's all going very well. Obviously, the scale is immense. So to try and dissect the business would take a whole series of podcasts, which I'm absolutely prepared to do. But if you could kindly fill the audience in on what it is that your title means and what you're doing with BlackRock right now.
Yeah, so as I said, I'm responsible for UK banks and digital business in the UK, and it's one of the largest and fastest growing areas of our firm in Europe. And ultimately, my role is for managing a client base and delivering the whole suite of BlackRock investment and technology solutions to private banks, retail banks, challenger banks, and then the digital channels, which we tend to split up kind of into 3, which is DIY platforms, the robos, and then the non-financials. As you said, I've been here, been at BlackRock for 8 years, pretty much predominantly within the iShares business. So I've been chief of staff for the iShares business in Europe, and I was head of iShares in the UK. iShares is the indexing brand of BlackRock, so ETFs and index mutual funds. And really, BlackRock's mission is a fairly simple one: is to create better financial futures, for our clients. And our clients generally tend to be financial intermediaries, so banks, insurance companies, pension funds. Not the end client. So BlackRock tends to be, an intermediary, organization. I think the other important thing to realize about BlackRock is that while it's the world's largest asset manager, it's also the world's preeminent supplier of sort of investment technology through our system called Aladdin. And really, this is kind of the beating heart of BlackRock, and the operating system that not only our business runs on, but lots of institutions across the world. So, BlackRock is kind of, that whole collision of financial services and technology is kind of what BlackRock has always been ever since it was founded 33 years ago.
Thanks for that, Joe. That's really useful. I really want to dig into a variety of things you just brought up there. Having said that, I think what will allow us to do that is if we can understand your part in it in your journey, and how we got to kind of getting BlackRock and yourself onto the podcast, which to date has mainly been in Fintech, so in digital challenges, is because you're involved with working with those, and it's fascinating to understand the interplay with big institutions like BlackRock and challenger digital institutes like Nutmeg, for instance. But let's come back to that. I want to go through your journey and your career, because that's equally fascinating to our audience. So you were studying economics and philosophy, University of Leeds, graduated 2006, I believe, and then went and joined immediately Goldman Sachs in their private wealth division.
Yeah.
Can you so that's relatable to a number of grads in that type of that kind of subject who are considering where to go. Can you explain what it was like when you joined Goldman Sachs in that division?
Yeah, I mean, it was 2006, so the world was a very different place to what it looks like now, and we hadn't been through the global financial crisis, so there was no concept of that. But Goldman was a fantastic place to kind of start your career, to learn. Like a lot of the things I can see myself doing now were, as a result of, some of the things I learned at Goldman. I think the people there that I learned from were also, incredible, and the culture as well. And that's really kind of left a lasting impression on me around, kind of the firm I want to work for. And Goldman also had a deep purpose about what they were doing. So like it was a fantastic place to grow up, and a fantastic place to kind of sort of develop some of the things in your career. And as you said, I started in the private wealth management division. I really got to understand kind of how a private bank or a private wealth manager operates. And actually, I spent time in China and Brazil in 2009, post the crisis, actually helping to build out the private wealth management sort of offices and businesses in those markets. So they start starting really like from the start. How do you even go about building out some of those businesses? So not only was I seeing new cultures and new way of doing things, but hugely beneficial just to understand how the pieces all fit together. And a lot of that stuff I'll still use to this day when I get faced with some of the challenges that my clients who are now wealth managers are presenting me with. In and around, okay, how does this fit together? How do we do this? We've got this challenge. What could the potential solution be? So that also, I think, really kind of honed my love and my kind of appetite for challenges and finding solutions for clients.
What was your motivation in those first several years of your career? What was really driving the decision to go to Goldman's, to get experience in going to different territories, to try and learn different products?
I think it was like appetite for learning. And while I was at school, I think it's fair to say that the sports field really had my heart. And even potentially at university, kind of my main priority. But as I started at Goldman, I really found like exciting, interesting work. And I was learning something new every day. And I think that's one of the most important things I've kind of carried throughout my career, right? Is like, when you're learning new things, when you're kind of evolving your own kind of skill set, that's when you're kind of happy, and that's when you're committed, and that's when you're at your best. And so, if you think about going to China and trying to understand how a wealth management market in China works, and then how you build a wealth management business on top of that, that is a huge amount of learning to go through. So, I think it was like so many different things, and also these things I kind of knew, they were going to be very, very useful later on in my career. So there was a really incentivization to kind of learn them, and very different every day. So there was never a situation where I kind of had a role where I'd come in and just process stuff, or I'd have a very similar role. Every day was different, and I actually really like that. I like the okay, you might have a certain things you do fairly repetitively, but generally speaking, I like it when you don't know what the kind of day holds for you. In terms of some of the things that your work can throw up.
In 2006, the kind of more obvious, I think, places to go if you wanted to do really well in finance were the larger firms. Certainly my peer group were looking to go to the big names like JP Morgan, Goldman Sachs, etc. Obviously, where we've been over the last several years, with technology companies coming out the blocks and becoming global players, then some of the brightest graduates look to go join those. And I think we're moving into an interesting phase where there's an option, right? There's no right thing to do. It depends what your ambitions are and potentially what sector you're going into and what skill set you're taking to it. If you were giving any advice to graduates coming out of economics, finance, management type of degrees and looking at finance, that's their passion. That's where they want to have a career and they're trying to work out what the future of finance is. Do you recommend that they go join a big firm because of the scope of work and the security and the diversity of challenges? Do you recommend that they go join a challenger? How do they answer that? How do they think what the right strategic career move is in those first 7 years now?
I mean, I think very few careers are linear, right? And very few careers, you may not find where you want to be initially. And so I think as long as you're developing, as long as you're learning, and like acquiring a diverse skill set, then I don't think there's a right or a wrong answer to that question. And certain people may be suited to big firms, and others may be suited to smaller firms. But as I said, that critical thing is you don't have to go into exactly what you think you'll end up in, because often, even if you do go into that, kind of your view will change. So I think going into something you're passionate about, and a firm with purpose, and if you can kind of marry together your own purpose and kind of the firm you work for's purpose, I think that's a pretty good way to start off, or a good basis point.
Yeah, absolutely. And I think the thing that takes the pressure off those first 7 years is if you take a 10, 20 year view and don't put too much stress, like you say, on getting, each quarter correct, and just go into each opportunity with the attitude of learning, being passionate, and then, if you have to move, you have to move. Nonetheless, you are a guy who's worked at Goldman Sachs and BlackRock. I was reading an article in the last week which said BlackRock is the new Goldman Sachs. So I was trying to work out what exactly that means. But what would you say is the difference between the culture? This is very generic. It depends what division you are. But the places that you've worked within Goldman Sachs and BlackRock.
I mean, they are, they're very different firms, but they're also, there's some, similarities. Both of them, have a really clear culture, and a market leaders in what they do, and a passion to stay there. And I also think they have a huge amount of purpose, and purpose is, this word that I think is the most important thing when you're kind of thinking about a firm you want to work for, and what is that firm's purpose? What is it trying to achieve? And I think firms with strong purpose are the it is the most important thing within an organization, because then the rest of the people. So it's weird. Like I've never really, I think both of them were great firms, and both of them, with slightly different areas of the financial services ecosystem. But both of them I absolutely loved working for, and learned a huge amount.
So Joe, the podcast is called Searching for Mana, and Mana is a different way of saying purpose in essence. So I'm glad that we agree. That's the thing to look for.
I mean, for the guys out there, I remember there's a guy called Ted Sortier at Goldman Sachs, and he taught me something pretty early, which is, when someone asks you to do something, or if you can do something, if you say yes, the likelihood is they're going to ask you again. But don't just blindly say yes. So he taught me the yes but. So yes, but when do you need it for? Or yes, but. So I was always very conscious of that. I want to be asked to do things for stretch assignments and all that sort of stuff. And so that whole yes, but making sure you kind of find out a timeline, or yes, but I can't do it till next week, or whatever it may be. And so I think the whole thing with me has been about throwing my hat into the ring, aligning myself on the, on the purpose side of things. And then I think later on, as I've kind of developed and started to run my own businesses and teams, it's about being really focused and really deliberate. and underpinning everything you do with a kind of strategic, sort of mindset.
Yep, the yes, but that's awesome. So right now at BlackRock, where do you find the biggest element of your purpose drawing you towards?
So it's without a doubt sort of financial inclusion and financial well-being. And when you actually really just break it down, there are three parts to someone's health and happiness. There's their physical, their mental, and their financial. And a lot of the research we've done shows that financial well-being is the most important one to those three. But if you think about what we've done over the last 10 years in the UK around physical health, so wherever you go, people are wearing Fitbits, going to the gym 5 a day, 7 a day, whatever it may be, the way we eat, the way we drink water, everything, we've evolved enormously in and around our physical health. I think the same has happened on the mental side of things. The last 2 or 3 years, whether it's been sort of state-sponsored, celebrity-endorsed, workplace, sort of workplace aided. And so people are trying to really focus on the mental side of things as well. And then I think when we get to the financial side of things, I think that we could do a huge amount more within the UK to make sure that the millions of people that currently, don't have access to financial advice, who, don't have access to financial education, who, are being encouraged to go into debt through credit cards, without paying them off and on a monthly basis and this sort of stuff. So I think that's what really is, my purpose is in and around how do I help to solve, financial inclusion and financial well-being in the UK. And this is where technology comes in and the Fintech, sort of movement, which is technology is the enabler for this. Technology has the ability to scale it. And you think about, the unbanked, and suddenly now you have an app. You no longer have to have, a branch or whatever it may be. So, the rise of the challenger banks, I think, have been huge around sort of educating people around their finances. And I think we can do more in the savings and investment universe and tie it all together. And I also happen to think one of the unintended consequences of COVID, and one of the positive consequences of COVID, is that people are really going to want to get their finances in state. Because I think COVID, compared to the other crises we've seen in the 20th century, COVID is about the real economy and real people. And people have gone from having jobs to suddenly, the following week being furloughed or to not having jobs. We're seeing bank balances shrink. And we're seeing, credit card debt go up or debt increase. And so as we emerge from this crisis, I think more than ever, a lot of the stuff we've been saying around financial inclusion, financial well-being, is going to be really, really important. And it's kind of like, how do we engage people and get people to think about it more broadly? So my purpose is always, it's obviously to kind of help my clients, and, BlackRock's mission perfectly sums up what I'm trying to do to create better financial futures for my clients. But also I think there's an element here around financial inclusion, and that's what really kind of gets me up every day, which is like, how do we provide, a better financial future to millions of people in the UK and beyond?
And so we're in June 2020. The beginning of the year, January, Larry Fink, who's the founder, CEO of BlackRock, I don't know if you'd call it a mission statement, but certainly wrote a letter, an open letter, all about sustainable investment. And that was a review of his business and a commitment to changing the way that, of course, you operated moving forward, and what would be in various type of portfolios. Can you talk us through that, Joe, please?
Yes, I think Larry's letter, which by the way isn't new. It's been going for a number of years. But I think the reason why this one kind of got so much attention was really that kind of acceleration of our efforts around this space, and really focused on kind of three key areas. The first one is building sustainable and resilient portfolios. The second one was increasing access to sustainable investing, So this is the number of products we have. And the third one was kind of enhancing our stewardship approach. So how do we engage with companies, in and around sustainability topics? And I think, we're on a journey here. The whole industry's on a journey. Everyone's on a journey. But what, I think Larry's letter and the subsequent, actions that we've taken, as well as the acceleration of efforts, is ultimately saying that this is, too big to ignore. And that, we believe that ESG and sustainable metrics, will become a significant part of investment considerations going forward. Whereas before it was, a little bit on the side, and so just we are working. I mean, it's the most topical conversation that comes up with our clients. We're working with pretty much all my clients kind of on delivering, either sustainable versions of their existing investment propositions, or just in integrating sustainability throughout their entire proposition. I also think it's not just about the products, right? It's about the company you are and how you think about, the way that you behave, and so we're kind of, conversations. I don't go through a day without having a conversation in and around this. The other thing I think, which is very relevant for your client base, or some of the stuff we just see around fintech and robo advisors, is that actually sustainable, there's a grassroots movement out there. And I spoke earlier about trying to get the UK population engaged in their financial services. And if you think about what people talk about around climate change, around going to supermarkets with plastic bags, chaining themselves to bridges, even some of the stuff around the last week we've seen, around social injustice. Actually, if you want to have a real effect on this, it's about allocating capital to the right places. So, what are you doing in your pension fund? Is your pension fund, thinking about sustainable values? And so hopefully the industry can connect this grassroots movement and sustainability and get customers engaged in their investments as well. Because, as I said, the best way to move in forward is going to be by allocating capital to the right places, and that's kind of the crux of it.
Yeah, thanks for that, Joe. With the move to sustainable investment, can you try and explain how that's been real? So clearly, there's been a commitment to putting different type of investment into different types of business. Could you paint the picture slightly more so that we could understand now what those might be?
Yeah, so typically, when you'd buy a fund or you buy an ETF, ultimately what you'd be buying is kind of a benchmark. So one of the well-known benchmarks, the FTSE 100, the S&P, and depending whether you're active or index, you might have an active manager sitting there trying to outperform from a performance perspective that benchmark. Now, I think often, some of the considerations that an active manager would actually look at would be around the company's sustainability, would be around the company's ESG, but that wasn't necessarily explicit. And on the index side of things, the FTSE 100, the S&P 500, that had absolutely no context in and around kind of ESG scoring or sustainability. What's happened over the last 3 years, and actually, going back further for some clients, has been a requirement to have certain scores or a certain eye on kind of ESG metrics, sustainable metrics. And so what we've ended up doing is, in addition to the products that are just either looking to outperform the benchmark or track the benchmark, we've actually developed products that actually are, we've developed indices, or indexes that are actually focused on enhancing ESG scoring. So giving capital to companies that are doing better, not just because they're larger in the benchmark. Okay. And so actually now what you get is, and actually what's recently shown, like in the first quarter, we track 57 sustainable indices, and 51 outperformed their parent benchmark. So obviously also, like, more and more people are starting to look at this, and the companies that are sustainable, that are doing things around ESG, are also actually companies that are now starting to outperform their peers. So it's kind of almost like a circular effect when it comes down to it. And so now, if you want to build a portfolio, previously you would have had a fairly limited scope of products, but over the last 3 years, certainly within BlackRock, we built out a huge suite of index products, so ETFs, that you can use that provide you with a better ESG score, as well as all active managers now have it as an absolute part of their kind of consideration when they're looking to try and outperform the index. So it's almost become kind of I think it's on a journey, but often we'll underestimate we'll overestimate the effect in the short term and underestimate it in the medium to long term. And actually, sustainability has been one of those things that I think continues to take people by surprise in terms of the momentum it has, and the kind of how it's actually kind of exceeding expectations in terms of demand and that sort of stuff. And we saw this through COVID. The first quarter, we saw a huge amount of inflows, $40 billion globally going to sustainable mutual funds and ETFs. And that's in the face of a lot of people selling out of products and going into cash. So that momentum continues unabated and almost comes out of COVID and some of the instances we've seen in the US, kind of almost more important. And that's actually what we've seen as a result of COVID, right? The certain things actually are just happening quicker. And I think, technology and fintech is another one where, suddenly firms have gone from sitting around in an office with people and meeting clients face to face to suddenly, having this, which is interesting. So, yeah.
I think, incentives tend to dictate behavior. So, if we think about wealth management or investment banking previously, and potentially the last financial crisis, where big banks were the villain, certainly from a perception perspective. And if you go back and look at the incentives of the people in those businesses, of course it was crudely to make as much money as possible, right? And then if we listen to what you've just said, of course, you can have good intentions because it's good branding or marketing or sentiment. But when you actually hear that now you're able to do just as well with sustainable investment, but actually potentially we've got to this tipping point where you could do better because there's the network effect of more people want to invest. It's a better feeling. And because of that, those stocks are going to get more investment into them. And therefore, those are going to be the stocks that possibly do better. Then, hopefully we move into a future of finance when the incentive is aligned with doing the right thing. And it's really exciting to hear that, obviously, you guys at BlackRock are seeing this.
I think I bore people at dinner parties and out and about. But I think you rarely go anywhere without climate change or the events of the US in the last couple of weeks coming up. And I kind of say to people, well, what are you doing about it personally? And I truly believe that one of the best ways to affect change is by calling up your wealth manager, your Robo Advisor, your pension provider, and saying, is my money invested in something that is allocating capital to the most sustainable companies or companies that are doing stuff, with the most in terms of the E, S, and G scoring. And I think that call to action, I think, is really important. And if we can do that as well, Lloyd, that's, I spoke about the problem about financial inclusion and actually getting people engaged in their investments. The investments, I like to often think of them as the engine of the car, right? The engine of the car, the most important part of the car, gets you from A to B, but actually 90% of the population, perhaps 95% of the population, have never seen the engine of their car. They might know a couple of facts about it. but it's absolutely critical. They're not buying, they're not buying the engine. They're buying the leather seats. They're buying the stereo system. They're buying the color, and they're buying. And that's where I think we need to position investments. Now, I think people are absolutely going out there and buying electric cars, and that's been a really good thing for people to kind of get engaged in the, within the car market. And so, I honestly think that sustainable investing can actually get a broader set of people involved in kind of thinking about their investments, thinking about their financial future. Because actually, a very basic portfolio of ETFs, and it's interesting if you're really into investments, but for the average person on the street, they're trying to hit a goal. They want to, save for their children's education, or they want to, save for their daughter's marriage, or whatever it may be. They don't necessarily kind of are really in the ins and outs of different stocks and how they're performing and that sort of stuff. So I think the whole thing can actually bring investing into the mainstream and get people really, really excited about it.
Yeah, I agree. And I think that ties us nicely into talking about fintech, as you've touched on a number of times. Because if I think of that, normal person in the street, then I just think that there's an intimidation of considering BlackRock or one of these big firms as having any potential use to them for those goals that they might have, which could be, as you say, saving for a property, paying the bills, just feeling like they're doing the right thing with their financial wellness. And I think what the emergence of some of the fintech companies provided was a fresh lens on that. The branding was, we're new, we're doing this to service you in particular. It was less confusing, and it allowed people to think, okay, this is cool. If I put £50, £200, £1,000, whatever it was, a month into this product, now this is great. And those little steps allowed people to start understanding why that might be a really good thing to do. What has been the experience for you and BlackRock? Did you have to therefore partner with fintech businesses so that you could be providing, the funds behind the scenes, the engine, so to speak?
Exactly.
And could you talk us through that, please?
Yeah. So I ultimately want to build the engine for these firms. These firms are, very good at customer acquisition. They're very good at, kind of engaging customers, and they're very good at segmenting their client and understanding how to get to them and marketing to them and that sort of stuff. But what they need is an engine that, that's suitable for their client base. And so whatever it may be, we can build a vast plethora of engines kind of at BlackRock. So whether you want it to go from, 0 to 60 very, very quickly, or whether you want it to be electric, or, whether you want it to be a low cost engine, or a blend of active and index. So we can build whatever engine. And so we've been focused on doing that. And we've also been focused on, like through our partnership with Scalable Capital, and Embark, we've also been pretty heavily involved in helping our existing client base, which the banks, the wealth managers, advisory firms, other asset managers, to help them build digital propositions. So we've got a fair amount of expertise in this space now in terms of what works and what doesn't work, and how to get something to market. And so we've been also kind of helping, our customers, along that.
Joe, let's say I've got £10,000 and I want to go to 0 to 60 really quickly, but I'm not gonna, go and invest in crypto because I don't know what I'm doing. I don't have the time for it.
Yeah.
So I want to use some type of product that you'd recommend. What would it be?
I think that's an almost impossible question, but so ultimately, I think you have short-term goals, you have mid-term goals, and you have longer-term goals. And a short-term goal, to be honest, is probably less than 3 to 5 years. you probably shouldn't be, that's where you put in cash or something that's fairly safe in and around, a bank account that's going to pay you an interest. You might want to lock it up in terms of a deposit, for 6 months or a year, so you get a bit more interest. I think as you then start to play it out further, that's when you have to kind of really assess okay, what's the product that's most suitable for me, and also what's the product that's going to kind of align best with my purpose. And sometimes that may be something that more interesting. It may be that someone's going to do it for you, or you're going to do it yourself on one of the DIY investment platforms. There's a huge amount. I think the most important thing, though, is not actually about what you're investing in as such. It's that A, you're doing it, and B, you're doing it like regularly and often. And if you think about the way I like to think about this is actually, the whole thing around physical health. We didn't all go out and become like sports science majors. And this is the intimidation point you leave, right? There are some gyms that the average person goes into and goes, well, it's, on the beach in LA or whatever it may be with the bodybuilders. But actually what we did is we just kind of gave these small little hygiene factors that people would do. And what it is, right? Like I know in the morning I need to drink a lot of water. Like that's been drilled into me. Or I should be eating fruit, over a bag of crisps or whatever it may be. And I think the same thing we need to do in financial services and investing. So, and actually it's not necessarily about giving up. And I think one of the biggest problems we have is that investing is not a kind of pull. You don't wake up in the morning and think, I need to become an investor. I need to think about, and the other thing is it's very long term. So like investing for your pension, when you can't touch it until you're 55, for most like 20 and 30-year-olds, when you should actually be doing it, because by the time you get to 40, it becomes, you have to put more and more money in. So actually, I think some of the stuff like Roundup technology, so this is when you buy a coffee and it costs you £2.30 and 70p goes into an account. I love that Roundup technology. I think it's really, really useful because a couple of reasons. The first thing is that actually previously the whole rhetoric was like, don't have your morning coffee and save. And I'm kind of like, I really, really like my morning coffee. I want to keep my morning coffee. But wow, I'm going to have my morning coffee and then I'm going to put 70p into, kind of savings account. The other thing that Roundup Savings does, it doesn't matter the amount of transactions you're doing. So it's a massive democratization of it all because, whether you're spending £77.30 on breakfast or £7.30 on breakfast, the same 70p is still going in. And that £1,000 you're saving every year, I think is a really good start. You haven't given anything up. It's happened seamlessly in the background. But at the end of the year, I either can use it to pay off my debt, start to build a cash deposit or that. So I think we need to be a bit more inventive within the industry around, solving for the jobs that someone's trying to get done, rather than just saying, here is an investment account, you should be saving, you should be, and the old adage is we need to educate people. And like education is really, really difficult. And the only two times that education happens is when it's mandated, i.e. in schools and universities, or someone actually has a desire to do it. In which case we're not really trying to engage someone, right? Because they're already engaged. So I think that's also important. The other thing that goes on in the industry is a little bit of a scaring tactic. So, I think everyone's probably used one of those calculators, which, you put in some numbers and it basically says you're going to be driving Ubers until you're 122 because you don't have enough to retire and all that sort of stuff. And you need to save more. And I think every single firm that's done a really good job of like getting customers, like millions and billions of customers over the last 10 years, would probably say to you that kind of that's not a great place to start a client relationship in terms of being kind of scared into doing something. So I think we need to, there's various different ways we can do it. I think, thinking about what am I actually trying to get done? I also think about having finances in one place. I think that's coming, with open banking, with open finance. And you can see it going from, the kind of 12 bits of paper I used to have, I used to feed into a spreadsheet, used to give me a kind of an answer to kind of some of the questions I was asking, or the apps I now have. But someone is going to put it all together into, whether it's one of the challenger banks, or one of the the latest fintechs who can kind of suck in open banking data, and someone's going to put it in someone's hands. And this is what the best companies have done, right? They've moved from selling kind of products and services to actually putting the customer in the center, and then delivering unique, personalized experiences, to the customer.
Yeah. So, we are seeing right now some of those challenges that acquired millions of customers. And as you say, they're really good at acquiring customers quickly. I think because they segmented the customer acquisition and the targeting so precisely. And
Lloyd, by the way, that is absolutely critical, right? Like you think about trying to design a investment journey for an entire population. You've got 20-year-olds that need to pay off their debt to 55-year-olds that are trying to work out they got enough money to retire. Two very different conversations. So the people we've seen be most successful have actually been very, very focused on segmentation, and almost ignoring anything that sits outside of that, and being laser focused on, I'm going to focus on this cohort of clients. And the robos actually, who tended to be broad, actually it was very difficult. The other thing I think was problematic as well is going after a client base that had money, and potentially wasn't as they weren't digital natives, so kind of 45 years old and above, from a robo perspective. That's a really difficult client base to go after, because if they've got money, the likelihood is someone has been calling them already about their wealth manager, about their finances, and it might be a wealth manager or an advisor. So it's a person, a human, and suddenly they've been presented with an online advertisement and various other things. It's a really, really hard client base to go after. So I think that segmentation approach to say, this is who we're going to go after, and actually ignore everyone else, is super important. Sorry, I interrupted.
No. That's absolutely right. So I've got the exact same thing at Mana Search, which is the search firm that I run. So if we just go after everything, then we don't make any progress. So we're really small. So we can say, okay, we're a fintech specialist at this level in this particular skill set. And then suddenly you get to connect the dots, your reputation grows and you get really good at it. And I think what happens is then as you start having more success, you broaden out, right? And so if we go back to the intro where I explained, from 86 to now, you guys have literally become at BlackRock, across the whole globe, covering so many different things. Then the marketing challenge is different and needs to be, of course, nuanced. I think where we're at with fintech and the challenges is at this inflection point where they've become so successful in their niche, they have to broaden out slightly. And of course, there's been, for the really successful ones, broadening out in territories with the same proposition. But you start to see now, let's use Revolut as an example, because it's probably one that most people know or have used, quite a few different products on their platform. And then the feedback becomes, okay, well, this is a bit messy. What is this now? Or for some people, it's like, this is awesome. I get to do everything on here. And so it seems like we're at this really interesting point where, as you say, there could be either some of the big banks or some of these challengers have that high net worth individual and that low net worth individual all on their platform, all using all of the different facilities. And then we've moved along. We've moved from financial first to digital last, to digital first, financial last, and you getting the type of experience that you should in this day and age. And the question that I think you've got a really interesting perspective on is, what do you think is going to happen there? How do you see that landscape playing out? And which way round do you imagine that's going to go? Do you feel confident that the challenges are going to still survive, or are they going to get acquired into the larger banks, given we're in a COVID period, given there's recession, given we can see that people are losing their jobs in some of the coolest fintech businesses of the last 5 years? If I'm sat in BlackRock or Lloyd's or HSBC, I go and acquire that business cheap right now.
So, a couple of points. The first one is I don't think segmenting customers on amount of money, which is historically what the industry done, is necessarily the best thing. You can still have the same goals, and be very different types of net worth customer, as it were. So I think that more uniqueness has to be delivered, more personalization has to be done, and that's only going to come through data. And having a real good hand on your data and how it all works. So that's the first thing. I think the second thing I just say is there's been a sort of kind of, you're either digital or you're face to face. And that is kind of nonsensical in many ways. It's always been going to be a blend of the both, because we're humans. And the other thing, I think, it's also gone out the window off the back of COVID, because COVID, suddenly everyone had to become digital overnight. And it's probably been a good experience for people who thought it wasn't going to be a good experience. You think about your average advisor, they probably had the ability to Skype and to Zoom, their clients, but actually didn't do it. They'd go and visit them, or the client would come down to the London office or into their, Gloucester office or wherever it may be. And something that's changed. So I think what's the last 3 months has seen a 3-year leap forward, I think, from a wealth manager's perspective or financial services in terms of technology adoption. I also think it will be the kind of, there's been a lot of talk, people, a lot of projects, a lot of kind of, should we do this, should we do that, should we do this, and actually it's been pretty slow to get executed upon. And I think that COVID and one of the unintended consequences will actually be, kind of, how do we reinvent wealth management for 2020? Because that's what we're trying to do. We're not trying to build Robo Advisors. We're not trying to build how do we reinvent wealth management in a technical, digital way? Or not even in a technical digital way for 2020. And that's obviously going to have, an app. It's obviously going to have the ability to chat. And I think that's what we're trying to achieve. So I think, obviously very tough time for the fintechs. But if I honestly think if they can come through this, particularly some of the ones that are, like working in the B2B space, I think there'll be a renewed energy from the established organizations to do stuff with them in a way they haven't done it. And over the last 3 or 4 years, it's kind of has evolved and has been evolving. But again, to my point is that things are going to get quicker and quicker as a result of COVID and sort of and it used to be 3 years ago, it used to be like a 12-year-old school disco with the kind of the established city on one side of the room and the and the kind of fintechs on the other side of the room, and slowly they've been mingling. But now I can see that was already changing. So I think that's incredibly positive for things. The other thing is that we've seen an enormous increase. So Q1 saw record months or record signups to the robos as well as the online investment community, so the DIY platforms. And so it's clear that people want to get their stuff in order or their finances in order, but B, they kind of want to do it, online, because actually everyone's had to go online. There's been no difference in terms of how we're doing that. So I think, look, obviously an incredibly tough time. And COVID's been an enormously tough time, but we've seen technology leap forward 3 years in 3 months or almost overnight. And so if you can survive it as a young fintech, I think there's never been a better opportunity to kind of scale your business, work with partners, because there's a huge amount of appetite out there.
I was talking to Charlotte Crosswell, who's the CEO of Innovate Finance, and she recommended to reach out to you, Joe, because BlackRock was sponsoring an event of theirs. So Innovate Finance are a kind of organisation who promote the future of finance. And of course, after this conversation we've had, I can understand why you guys are collaborating. What I'm really excited to hear is that it feels like we've got to a point where, finance is just really exciting. It feels like it's doing all the right things. It's a big challenge, of course, but you found your purpose, as you say. I can see the passion in terms of, you know exactly what it is that you want to see wealth management look like. So if we just go, back to the career element, and you were to think, where do I, in my career, where do I want to be ultimately? And you're definitely on that path for sure. In 20 years, and you're reflecting and thinking, what am I doing this for? What am I going to be really proud of? What does that look like for me? Am I going to be a CEO? Am I going to, do this, that, or the other? You paint that picture for us.
Yeah. Again, it goes back to sort of financial inclusion and well-being. And like, if I think, if I can leave, if my legacy is that, there is a more financially sort of educated population. You see in America, like investments being talked outside school gates. And if we can see that happen, to get the millions of people that currently don't get any access to kind of any kind of guidance or advice, in the UK, and that we can get to a stage where, people have better financial well-being, and are happier, healthy, happy and healthy UK population, then that will, make me very happy in terms of, kind of my legacy. And, I absolutely appreciate that it's going to take, a huge number of people and a huge number of things, but that's kind of, as I said, my purpose. And, I'm in a great place to actually enable that. And that's really what gets me up every day in order to do it. And I love working with my partners. I love the fact that gradually it's coming towards, the direction of travel that we really wanted to go. And it's been slow. But I definitely think, going back to a previous point, COVID-19, compared to the other two crises, 2001 and the GFC, that we've gone through kind of in the last or in this century, actually COVID-19 and coming out of that, there is going to be kind of a real need for it and a real responsibility from an industry perspective, as well as I think a real desire from people to get it sorted. And we've seen that play through in a lot of the things that people are doing, and bank balances are shrinking, debt's increasing, so as we emerge out of this, like, how do we make sure that kind of, the people that really need to get their finances in order, and we start to pay off debt using roundup technology, so that they're not saddled with a huge amount of debt. We start to make sure they're saving for a rainy day. So, fingers crossed it doesn't happen, but when the next crisis comes along, people have that 3 to 6 month buffer. And then we get them to start to save for the longer term, or invest for the longer term. And so, I think the retirement crisis that's coming down the pipe, and if you think about the shift that we've seen, 20 years ago, like, it was the state and the corporate's responsibility ultimately to kind of serve you in retirement, right, and look after you in retirement. That's completely flipped on its head. When you look at people like you and I, Lloyd, like, we are, absolutely going to have to fend for ourselves. And the other thing that's happened is modern medicine's taken such a dramatic leap forward that suddenly we're looking to, I think 1 in 4 of us will live till we're 100, right? Which is dramatic increase in life expectancy. So I think all these things coupled together, mean that absolutely, like, it has to be done now. And it has to be taken seriously with. And I really hope that kind of, COVID has been, an awful time for so many people. But I think if there's one thing that can come out of it, hopefully accelerates this, so that people actually take control of their finances. And we have the technology to do it now. There are firms, and it's not like we're looking back 5 or 6 years where there was very little for people to actually get their heads around. There's a huge amount of help out there. It's just, as I say, making sure that it engages people in the right way. It kind of looks after some of the things they're trying to do, sells them the car, not the engine.
Joe, that is something that we can all rally behind together. Cheers, mate. That was awesome.
Cool. Thanks, mate.